What's up, weekend warriors? I'm research analyst Nick Antonucci with Henssler Financial, here to help you put some extra bang in your buck on another edition of Casual Finance Friday. Now, we all know about the sexy asset class of stocks, and oftentimes this is all we hear about when financial markets are discussed on the nightly news. And let's be honest, who doesn't want to pick the next hot stock and make a ton of money, right? But we can't ignore the other asset classes out there, particularly bonds. So let's take a quick crash course on the boring asset class of bonds.
Get down, baby.
What is a bond? Bonds are debt securities issued by various governments and corporations in order to raise money to fund any number of projects. Think about a city needing to raise funds to build a new bridge, or a corporation, let's say Apple, needing to borrow money to fund the development of the latest and greatest version of the iPhone. Well, there are many different types of bonds issued for different purposes, with no two being exactly the same. Generally speaking, bonds are issued for a defined period of time at either a variable or a fixed rate of interest that the borrower promises to pay the holder periodically. The frequency of payment varies from bond to bond, as does the amount of the payment. In most cases, the periodic interest payment, or what is called the coupon, is made on a semi-annual basis. Obviously, everything has gone electronic these days, but the term coupon remains. At the end of the defined life of the bond, or at its maturity, the issuer returns the principal amount to the holder on top of the coupon payment. Each bond is theoretically issued at what is called the par value, which in most cases is $1,000 per bond. Now, not all bonds are created equal, meaning that some have higher coupons than others, some don't pay coupons, some have longer dated maturities than others, and there's a whole slew of other features and covenants that can pertain to a bond. But for now, we'll keep it simple. So, why do some bonds have higher coupon rates than others? Well, bonds can have different coupon rates for a number of different reasons, but most likely it's a result of when the bond was issued and what the interest rate environment was like at that time. Creditworthiness can also come into play in determining what a bond's coupon is. Bonds issued in more recent years most likely have a lower coupon than those issued many years ago, which is a function of the Fed's action to lower benchmark interest rates to historic lows. These benchmark interest rates are the base for determining the interest rate that a bond will pay. Also, some governments and corporations are less risky than others, meaning they have a stronger balance sheet and therefore greater ability to service their debt, making them less likely to default on their debt. As a result, investors aren't compensated as highly when they take on less risk. As I mentioned, in some cases, bonds don't pay a coupon. These are referred to as zero coupon bonds, and they instead issue at a steep discount to par value and later mature at par value. While the bondholder does not receive periodic coupon payments, they do receive a lump sum payment at maturity that is greater than the amount for which they purchased the bond. So why do people buy bonds? Bonds provide a predictable stream of income that other investments such as stocks do not. Bonds also provide a way to diversify an investor's portfolio thanks to their different risk and return profile from stocks and other asset classes. Some bonds also have tax advantages, allowing the holder of the bonds to receive tax-free income. While all investments have risks, bonds are generally considered less risky than stocks, but are not without risk. Let's look at what bonds did during the financial crisis. From the top of the market on October 9, 2007 to the bottom of the market on March 9, 2009, the Barclays Aggregate Bond Index rose 7.18% compared to the S&P 500's return of -55%. So what is our strategy for purchasing bonds? As you've likely heard, we recommend our clients follow a 10-year rule. This means that any money you need in the next 10 years should be invested in high-quality fixed income instruments such as municipal bonds or CDs and not exposed to the volatility of equity markets. We determine our clients' spending needs in the next 10 years and build a bond ladder for them. What a bond ladder means is that we match the amount of fixed income that needs to mature each year with the amount of money the client needs for spending. It's also our practice to hold those bonds to maturity. By doing this, we eliminate the risk of having to sell your bond at a discount as a result of interest rate movements or selling at a discount to quickly find a willing buyer so you can free up that cash. This allows us to know the exact cash flow that client will receive at the time of maturity. We hope you found this helpful in understanding the basics of a bond. My name is Nick Antonucci, research analyst at Henssler Financial, signing off on a very casual Finance Friday. Thank you.